Okay, guys, we have already started IFRS 15. Thanks for your. Yes, IFRS 15 is relevant to that of the revenue. Revenue is IFRS 15 regarding revenue. And today we will discuss about the contract costs. There are some costs that need to be capitalized. So let me first explain and then we will read this talk. Clear? Here. Okay, here. Okay, you have a contract. Okay, and obtaining and or may you say fulfilling this contract, you will have to incur some cost. Okay, and that cost need to be capitalized. That cost need to be capitalized. So when you are obtaining a contract for or fulfilling a contract, then you have to incur some cost, and that cost need to be capitalized. What does we mean by capitalization? By capitalization, we means that you have to record it as an asset. Okay, and once you record this asset, then definitely you have to amortize that asset over time. So the amortized amount should be expense to profit or loss. Okay, now obtaining a contract, then that cost is a specific cost that is directly related to acquiring a contract. Okay, obtaining cost is those costs or that costs which are specific costs that are directly related to acquiring the contract, and you have to exclude those costs which are you may say that that would have been anchored even without obtaining the contract. For example, some legal fees, you may say traveling costs that will be incurred regardless of the contract. You get in the contract or not, but the cost will be anchored. And this is called, I think, sunk cost. In simple terminology, if you are looking for the cost accounting, management accounting, then this is concept of sunk cost. Clear? Now, fulfilling a contract, this cost is the cost related to carrying out the terms of the contract as long as covered as not covered by another standard and and expect to recover them. So the fulfilling cost is the cost related to carrying out the terms of the contract, and this cost is expected to be recovered, and this is not covered by any other standard. And obtaining a contract is a specific cost that is directly related to acquiring the contract, and you should exclude the legal fees or the what we call as traveling costs that will be anchored, have been anchored regardless of the contract. Clear? Now, now you have some other costs that we call as uh, general cost and uh, wasted cost. Wasted cost, by wasted cost we mean that material wasted or labor. So that sort of cost should also be expense to the profit or loss. Clear? So what actually we have studied is this. You see here, IFRS 15 said that the following cost must be recognized as an asset. Okay, mean capitalized. The first one is the cost of obtaining a contract. The second one is the cost of fulfilling a contract. Clear? So this cost of obtaining a contract must exclude the cost that could have been incurred regardless of whether the contract was obtained or not. So, for example, you have legal fees or cost traveling to the tender, then that cost should not be the part of the capital cost, because this cost is not related to the contract. It could be anchored uh, if you are getting the contract or not. Clear? So this means that these are the specific costs uh, that are directly related to the contract, so that should be included as a cost of the asset, and that should be capitalized and amortized over time. So you understand the concept that cost of obtaining, what does we mean by the cost of obtaining a contract, and what should be excluded from that cost. Clear? Then you have another concept, and that is the cost of fulfilling a contract if they do not fall within the scope of another. So, mean if this is not deal by the another standard, then you should deal it here and the IFRS 15. Clear? An entity expected them to be recovered. So, mean there's expectation that you recover that amount. So that cost should also be capitalized. Now, the capitalized cost, which I have told you before, for obtaining a fulfilling contract, will be amortized, and that cost should be expense, to profit and loss. The capitalized cost of obtaining fulfilling contract will be amortized to the statement of profit and loss as revenue is recognized. So when you recognize the revenue, then you have to also expense that amount, capitalize the amortization of capitalized asset to profit and loss. Clear? Now there are some general costs and costs of wasted labor that should also be expensed to the profit or loss. Clear? Okay, this is the contract cost. Now let's move on. We have, I think, this is the question which we need to answer. We need to discuss. Clear? Okay. So the question is, stranger that stranger upper consultancy services. Let first me read the requirement. Discuss with the above cost can be capitalized in accordance with IFRS 15. Now the question is, a stranger mean as upper consultancy service, it anchored the following cost that was unsuccessfully contracted. external fees anchored in researching a potential customer, traveling costs to deliver the proposal, and commission to sales staff for winning the bid. Clear? So we have already discussed that you have to include or capitalize all the costs that are directly related to obtaining the contract or fulfilling the contract. The remaining cost should not be capitalized and should be expensed to the profit or loss. So in this question, as you see here, there is external fees anchored researching potential customer, that is 30,000. So this should be expense. And why I'm saying that this should be expense, these fees are anchored as a part of research and the preparation to submit a proposal. Clear? So however, they would have been anchored regardless of whether the contract bid was successful or not. So according to IFRS, costs that are not directly attributable to obtaining the contract or that are anchored regardless of the contract outcome should not be capitalized. Clear? So therefore, these costs must be expensed, in the period in which they are anchored. Clear? Now the second one, you see here the traveling cost to deliver the proposal, that is 20,000, and this cost is also expense to the profit or loss. And the reason behind is this, that this is these traveling costs were anchored to deliver the proposal, and they would have been anchored even if the contract bid was successful or not successful. So, since these costs are not directly related or attributable to obtain the contract and would not have been anchored specifically because of the contract success, so they must be expensed to the profit or loss. Clear? And then you have the commission to sales staff for winning the bid. So this is the commission to sales staff for winning the bid, and that is 15,000. Now here, this amount should be capitalized, and you should amortize this. Then, uh, why this amount is capitalized in asset? This commission is directly attributable to obtaining the contract. For winning the bid, obtaining the contract. So the commission would not have been anchored without securing the contract. So I mean this is directly related to the contract. Clear? And the costs are expected to be recovered through the revenue, definitely. And the contract is successful, so whatever you earn is a revenue from the contract, so the cost is also recovered. Now under IFRS 15, the cost of obtaining a contract such as this one, a sale commission, should be capitalized in asset and then amortized over the period in which the related revenue is recognized. So in simple terminology, we say that 15,000, at 15,000, this amount commission capitalized, that should be capitalized and must you have to amortize over its useful life or a period in which the revenue is recognized. And the external piece, that is 30,000, that should also be expensed to profit loss, and then 20 traveling costs should also be expensed to the profit or loss. Clear? Now let's move on. We have the presentation on the statement of financial position. Okay, so what does we mean by the presentation on the state of financial position? So when entity recognize revenue before it has received. Okay, let me explain it here. Okay, this is called presentation and on the statement of financial position, on the statement of financial position. Clear? So revenue recognized before consideration received. Revenue recognized before consideration received. So when entity has recognized the revenue fair and has received the consideration, then it should be recognized either as a receivable or as a contract asset. By receivable, this is the unconditional right to get paid, but you need time for this. So passage of time is required. Clear? And what about contract asset? Contract asset, this is the conditional right to get paid. Clear? So what does we mean by this is always simple. When you are recognizing the revenue, okay, then that revenue uh, which is before the payment means when the company on the revenue but hasn't been paid yet, it need to recognize what it is owed in its financial statement. So by receivable we means by receivable we mean that when the company has unconditional right to get paid, but only the passage of time required. For example, if the company complete work and only has to wait for the agreed payment date, let's say 30 days, 90 days, then it recognize this is a receivable. So this is the presentation. Clear? This means that the company regard the amount or is money owed at. Clear? On the other hand, you have the contract asset. What it means when the company has earned the revenue, mean you have earned the revenue but doesn't yet have unconditional rights. You don't have unconditional right like that of receiver, but you have some conditional right to get paid. Mean the payment is still conditional on some other factor. For example, if the company has done part of the work, but the payment is only due when more work is completed, so it regards as a contract asset. Clear? So the company regards the amount is work completed, but not yet fully entitled to receive the payment. Clear? And there is another concept that we call as contract liability. Contract liabilities. This is actually when a company has received payment or has the right to receive before completing work. So this means that when a company has received payment or has the right to receive the payment before completing the work or earning the revenue, then that is called your contract liability. For example, if a company is paid upfront before the work is done, it regards this amount as a contract liability because it still owes the work. So the company recognized this is obligation. Okay, this is the obligation. This is the obligation to deliver goods or services in the future. So what we have learned about the presentation, that you have receivable, you have contract asset, and then you have contract liability. Okay, about contract asset we have discussed that company has earned the revenue and just need to wait for the payment. And about contract asset, we have explained that company has earned revenue but payment is still conditional. Okay, and about contract liability, we have discussed that company has received payment but hasn't earned the revenue yet. So that is your contract liability. Clear? Let's move on to the here. Here you see, when the entity has recognized revenue before it has received the consideration, then it should recognize either receivable or contract asset. By receivable, we mean that right to consideration is unconditional, and contract asset is, the conditional right to get paid, right? And then entity has unconditional right to receive the consideration if only the passage of time is required before the payment is due. So this is actually related to the receivable. Clear? Then contract liability. Contract liability it should be recognized if the entity has received consideration or his unconditional right to receive consideration before related revenue has been recognized. So this means that the company recognize this is an obligation. The contract liability is an obligation to deliver the goods or services. Clear? Okay, this is the presentation on the state of financial. Now we have another concept, and that is disclosure. I think we are just wrapping it up here. This is the disclosure that IFRS 15 requires some disclosure. Okay, so the first one is require an entity to disclose revenue recognized from contract with the customers. So this means that company must show how much revenue it has earned from the contract with the customer during the period, and why it matters. This will help. This will help the investor. So, and stakeholders understand the total revenue the company has generated from its contract. Clear? So you have to disclose the revenue recognized. Then you have contract balances and asset recognized from cost anchored obtaining or fulfilling contract. We have discussed this. Contract balances and asset recognized from the cost anchored obtaining or fulfilling the contract. So this means that the company must disclose any amount it has recorded as a receivable. They have to disclose contract asset. They have also to disclose the contract liability. They have also to disclose the cost capitalized, cost spent on obtaining or fulfilling the contract. So cost capitalized should also be disclosed. And why it matters, this help to understand the financial position of the company, showing how much money is owed or advance. So this will tell us about the position of the business. Clear? And then you have another very important, that is significant judgment, because we are there's some judgmental scenario in this revenue when you are recognizing the revenue. So you have to disclose those significant judgments used in any changes in the judgment. This means that the company must disclose important decision it made when applying IFRS 5. For example, how it decide when to recognize the revenue, how it determine the timing and the amount of revenue to recognize. So any change in the judgment, and why it matters. This provides transparency helping user financial statement to understand how the company arrived at such a certain decision. Clear? So these are the key points you have to understand about disclosure. That what we have said. The first one we said that revenue from the contract should be disclosed. Then we said that contract balances like receivable, contract asset, and liability, and then judgment made. So these things should be disclosed. Okay. Now let's move on. We have another, and that is completely about the judgment. Okay. Let me zoom it. View. Okay, here. Management, judgment is required throughout the revenue recognition. So revenue process, there was some judgment. The first one is, wait, here, that contract with the customer don't need to be in writing, but may arises through customary business practices. An entity must therefore ascertain whether it is constructive obligation to deliver a goods or services to the customer. Okay, so when contract with the customer, then contract don't always need to be a formal agreement, and they can arise through regular business practice. Words actually this statement explain. So the company must decide whether it has an obligation to deliver goods or services to customer, even if there is no formal written agreement. Clear? So they have to decide about the obligation. Then you have another judgment when you are making is a contract can only be accounted if it is probable that the entity will collect that consideration that it entitled to, whether benefits are probable is ultimately judgment. So this means that the company can only recognize revenue if it is likely it will actually receive the payment from the customer. So the judgment here is that management decide if it is probable the company will collect the agreed payment. Okay. Then you have the entity must identify distinct performance obligation in a contract. However, fast performances may give rise to expectation in a customer that goods services not specified in the contract will be transferred. The identification of distinct performance obligation thus relies on management judgment about both contract terms and impact of the entity faster behavior on the customer expectation. Okay, this actually means that the company must figure out this distinct goods or services it is providing to the customer. So the judgment is here that sometimes based on the past experience, customer may expect more than what's written in the contract. So management must decide if these expectations create obligation. Clear? Then you have here the variable consideration. Variable consideration should be included in the transaction prices if it is highly probable that significant reversal of the amount of cumulative revenue recognized to date will not occur. So this may involve making judgment about whether the performance due to target will be made. So this means that when we were discussing that time the variable consideration. So if the price changes, mean discounted bonuses, the company must decide if it is highly likely that these changes would not significantly affect the revenue. So judgment here is that this involves predicting whether the performance target will be met or not. Clear? Then you have here another, that is the transaction price must be allocated to distinct performance obligation based on observable standalone selling prices. However, the estimation technique must be used if observable prices are not available. So this means that if there are multiple goods or services, the total price must be divided among them, usually based on their selling prices. So judgment, if the prices are not correctly available, Then management use estimation method, and that is your judgment. Clear? Then you have a performance obligation as satisfies over time, revenue recognized based on the progress toward the completion of the performance obligation. So there are various ways to measure the completion using either input method, output method, and the entity must determine which are most faithfully represent the transaction. So this means that when you are uh, talking about the revenue recognition over times, then it means that if a good or services are delivered over times, then revenue is recognized based on the progress made. Clear? So the judgment here is that the management chooses the method to measure progress, input method or output method. So that is your judgment, and there you have to be clear. Now, if the performance obligation is satisfied at a point in time, then entity must use judgment or certain the date at which the control of the asset passes to customer. In simple term, you can say like that when if the goods or services are delivered all at once, so revenue is recognized when the customer gain control. So the judgment here is the management decide when the control passes to the customer. So this is your judgment. Then when the control of the asset transfer to the customer. So there's a lot of judgment, and you know why judgment matters. This is the first one is risk of manipulation. Because these judgments affect the recognition of revenues, there is a risk that the company might manipulate the profit. And there's some ethical guidelines that adhering to the SEC ethical uh, code is crucial to avoid any misuse of the judgment, and recognize the revenue. So in summary, we said that the key judgment and revenue recognition we have, which we have discussed one by one. Clear? We have discussed that obligation to deliver, based on the contract or the business practice. Okay, here, this is your obligation to deliver judgment. So based on the contract or the business practice. Then we have discussed collecting payment. This is another judgments. Is it probable that the company will be get fed? Then we have performance obligation. That is identifying what testing, and then variable consideration. When a price can change, it is probable that it will not affect the revenue. Then we all have also discussed allocating a transaction price, which means that using observable price or estimation. Then, we have discussed the revenue over time and at point in time. Clear? So measuring progress accurately and deciding when the control passes to the customer. So these judgments help ensure that revenue is recognized correctly under IFRS 15. So this is the end of this IFRS 15 standard. We have discussed the IFRS 15 with example, and after that we will practice the question from the kit. It may be BBP or maybe Kaplan. Okay, so thank you for watching.